Yeah,
So,
yeah, we have a good crowd today. That's great.
yeah.
Well, thank you all for joining us. As you can all guess, housing is the largest regular expense for most American families. And now real estate is booming, and although prices vary significantly across the nation, living in a lower cost area does not always ease the path to homeownership. Many families in less expensive regions struggle to buy a home because small mortgages are so hard to obtain. This webinar will look at Pew's study on the alternative financial arrangements that people use to buy lower cost homes and the barriers that lenders face to offering small mortgages, and inform policymakers and other stakeholders about market practices, evaluating borrower protections and experiences, and promoting access to safe, affordable home loans. And presenting today is Rachel Siegel, and Rachel's an officer with Pew's Home Financing Project, conducting original research and analysis on the safety and affordability of mortgages and on alternative financial arrangements for purchasing manufactured homes and other low-cost forms of housing. And before coming to Pew, Rachel worked for Santander Bank and Century Bank and interned at the Consumer Financial Protection Bureau. And we'll also hear from Tara Roche, is a research manager with Pew's Home Financing Project, conducting original analyses of the safety, affordability, and availability of small mortgages and alternative financial arrangements used to purchase manufactured homes and other low-cost forms of housing. Roche's previous work includes research on everyday financial products, including small dollar loans, mobile payments, and student loans, to inform policy recommendations that protect consumers from harmful practices and promote safe, transparent credit. Tara holds a bachelor's degree in English from the College of New Jersey. Did I see Serena on here?
Yes, you did.
From New Jersey, and a master's in public policy from Rutgers University. So let me turn this over to Tara and Rachel and to get us started. I know everybody's looking forward to hearing about this.
Well, thank you, Jody, so much for that wonderful introduction. And thanks to you and Brenna for setting this up. We're really excited to be here today to talk to you about this new project. As Jody mentioned, Rachel and I are an officer and manager on the team and helped launch this project in July last year. And so we're at a really good place to start chatting about some of the problems that we're seeing and the research that we have coming online in the next couple of years. So with that, let's dive in. So research increasingly demonstrates, and as Jody pointed out, that the relationship between a family's home and key aspects of their life is very important. As many of you know, it's the largest asset for most Americans. Not only does this provide stability, but it also allows people to tap into the equity on their home for a variety of things like starting a business and paying for a child's education. It also has a profound effect on health, including home quality and access to a healthy food and lifestyle. And this also has impacts on the quality and access to education and jobs, especially when people can't afford to live where they work. So let's talk a bit about how people pay for their homes. As many of you know, most people use a mortgage to finance the purchase of their home, but there are millions of other families that have used something else to finance that purchase, because small mortgages below $150,000 are hard to find and difficult for lenders to issue. So in the next couple of years, we're going to spend some time exploring those possible hurdles to expanding the supply of small mortgages. These can include regulatory barriers, challenges with the fixed origination costs that lenders have to pay, and also the incentives, which are right now as structured, they really drive large loan balances like jumbo loans and less so smaller mortgages. So there are a lot of folks who have strong credit profiles that are cut out from the market and can't find a small mortgage to purchase a low-cost home. And as Jody mentioned in the beginning, we're in an environment right now where there's pretty tight housing supply. So this is increasingly difficult for people to find. So what do folks do instead? Well, some continue to rent, but others get an alternative home financing arrangement. These can include land contracts, also known as contract for deed, lease purchase or rent to own arrangements, personal property loans, which are also known as home only or chattel loans, and those are specifically on manufactured homes, and seller financed mortgages. So there are some differences between these, but they do share similarities. I'd say at a high level, what's notable here is that they're all some kind of form of seller financing. So I'll talk a little bit about what that means. So seller financing differs from traditional mortgage sales in a few ways. So traditional mortgage, you have your buyer and your seller and another third-party entity. I didn't break out banks versus escrow and title companies. I've kind of lumped them together here for sake of simplicity. But what I want to underscore is what the arrangement looks like. So in this arrangement that most of you are probably familiar with, the house and the title or deed goes from the seller to the buyer. So if you've ever bought your home, you obviously have the home itself as well as a title or deed, and that's on file with your local county of recorder deeds as well. There's a note or a contract as well as down payment regular payments that go through the bank or the escrow entity, and then the seller gets their proceeds from the sale and moves on. However, in an alternative financing arrangement, the agreement is directly between the buyer and the seller. So the buyer provides usually a down payment, not always, and regular monthly payments, for example, to the seller. There's also a shared note or contract, but notable, the title of the deed is retained by the seller. That usually doesn't get handed over to the buyer until the final payment on the arrangement. And of course, the house is handed over to the buyer. So what I really want to underscore here is the difference in ownership. So in a typical mortgage arrangement, the title or deed goes to the buyer. But in most alternative financing arrangements, that is retained by the seller. And so what this does, it kind of confuses the home ownership, the legality of home ownership. And I'll talk a bit more about some of the challenges there. So stepping back a bit, we just want to flag that alternative financing is widespread. And different kinds of arrangements can be found, to be more common in different pockets around the country. So for example, lease purchase or seller financed mortgages, they are found across many states. And we are going to spend some time to dig in more into the prevalence and maybe disproportionate usage, found in certain pockets of the country. Personal property loans that are used for manufactured homes are also widespread, but they're concentrated in the Sun Belt. And as Rachel, she'll talk a little bit more about where some regions of the country are more likely to have personal property loans in manufactured housing. In the Midwest and the Southeast, these are areas of the country where land contracts are more common. Some of that could be due to the fact that states in these regions require recordation of those contracts. So not every state requires a buyer or a seller to record these. So there could be places where these exist, but we just don't know how common they are. And of course, there are some populations that are more likely to use forms of alternative financing than others. The most work in this space to date has been done on land contracts. And so what we know from that work is that African Americans in the Midwest and in the Southeast are more likely to use these arrangements, mostly because these were born out of redlining practices in the mid-20th century. And also Hispanics and Latinos in Texas and the colonias, there's a lot of land contract for deed arrangements that exist in those communities. So alternative financing laws are governed at the state level, and typically this is through statutes. There are some local ordinances that govern specific things that have to be found in the contracts, like the quality of the home or who is responsible for taxes or maintenance. There are also some major legal decisions that have come about that drive the way these contracts are governed. About half of states have laws, and again, those are usually on land contracts because it's likely the most common and well-known form of alternative financing. And notably, we've seen that these are often treated as contracts instead of property. So even though there's a home there, because it's a contract between two parties, it seems like that's often how states look at these arrangements and how the courts look at them as well. We won't get into a lot of detail here, but that does have a lot of impact on outcomes for buyers and sellers. So let's talk about some of the challenges and risks for alternative financing. We've broken these into three categories. So the risks to the buyer, this is the area where there's probably the most risk. The buyer doesn't have access to the equity because if you remember from that earlier slide, they don't really have clear ownership here. And so they're more likely to be evicted or foreclosed upon. The home quality may be compromised because there aren't always habitability standards the way there are in mortgage arrangements. There are also potentially unforeseen costs and fees. The family, the buyer, can't borrow against the home or receive federal estate assistance if they can't prove that home ownership. And again, usually that's proven by access to a title or a deed. Second category of risks that we talk about are to the seller. By and large, these are fairly minimal because in most states, the seller has the opportunity to evict the buyer in the event of non-payment. And from our initial research, it seems that most treatment through courts also tends to favor the seller. Now, there are cases where that's not the outcome, but by and large, it's less risky on the seller side when engaging in these kinds of alternative financing agreements. The last category is risks to state and local government. So I mentioned there's not always clarity about who is responsible for taxes and maintenance when one person is in possession of the home itself and the other person is in possession of the deed or the title. So this can lead to things like, people not staying on top of those, dilapidated homes, reduced home values. It's also difficult to target resources during disasters. So for example, during the last year, as the federal and state governments came out with different kinds of assistance, whether that's eviction assistance or some kind of financial assistance, most folks who are using some kind of alternative arrangement weren't able to avail themselves of that because they couldn't prove ownership. And it was also really difficult for government entities and agencies and others to figure out where these families lived, because in most places, again, there aren't really records of these arrangements. Now, it's also important to note that these kinds of arrangements exist on site-built single-family homes as well as manufactured homes. So the homes themselves don't look any different. It's just the kind of financing that the family or the buyer has used to purchase it. And so we see that as a risk, that folks who are able to obtain a home that any one of us could buy, potentially, they're going to have different protections and different responsibilities because they've used something other than a mortgage. So there are some unique risks and opportunities and challenges for folks living in manufactured homes, and I'm going to hand it over to Rachel to talk more about that area.
Thanks, Tara. Let's see.
Let me stop sharing my screen.
Sure.
Here we go.
Oh, there we go. Let's see. Okay. Oh, let's see. Can you guys see my?
Yep.
There we go.
I can see it.
There we go. All right. You can see the presentation.
Yes. Yeah, it looks good.
Okay, great. Thanks so much. Well, thanks, Tara. So I'm going to go through some of the unique situations for people who are buying or own manufactured housing. And first, I wanted to talk about what manufactured housing is, because there can be quite a bit of confusion about this. So here are some examples of what manufactured housing looks like, modern manufactured housing. This is one of the largest sources of unsubsidized affordable housing in the US. And the costs of a new home are about half that of site-built homes per square foot, even when land is excluded. These are really what mobile homes of the past grew up to be. They're manufactured in 1 to 3 sections and delivered by truck and then put together on site. And HUD has very specific building standards that make these much more like site-built homes than they previously were. They can be indistinguishable from site or stick-built homes, and they've been shown by the Urban Institute to appreciate similarly to site-built when they're placed on land that's owned by the same person who owns the home. And now this is a look at where manufactured housing is in the United States. And overall, manufactured housing makes up about 6% of the housing stock in the United States. But the Housing Assistance Council put together this map using the American Community Survey data. And it shows the percentage of manufactured housing as a percentage of overall housing stock. And I think it's really helpful to see all of the pockets around the country where manufactured housing is used much more. So to just give you a sense of it, the dark blue here that you see on the map is in areas where manufactured housing represents 30 to 54% of the housing stock in that area. And even though it's usually thought of as a type of housing stock used in more rural areas, and a larger proportion of manufactured housing is in those rural areas, still about half of all of those types of homes are located in metropolitan areas. And we're seeing an increasing number of cities starting to take steps to preserve manufactured housing or reduce barriers like zoning so that it can be leveraged as a source of affordable housing. And manufactured housing is an important source of this affordable housing. In general, we have lower income families who purchase these homes, and this is an important source of home ownership for low income families. And currently in the US, very few homes, new homes, are built at moderate prices. And it provides an efficient way to build new homes. It can be quick and less costly, and they can be used to build new neighborhoods for infill when dilapidated structures need to be demolished and taken out of the landscape. Also for disaster recovery and in hard to reach areas where it would be very difficult to build site-built homes. So I want to also talk about how there are certain challenges for ownership and titling in these homes. So first, let's back up and think about a usual home, a site-built, stick-built home. So if I wanted to go buy a home, I pick out my home or I find it in the landscape, but it's always attached to land and it's always as real property or real estate. And as long as I'm credit worthy, I would be able to purchase this home and get a mortgage on it. But manufactured housing is different. So let's say I'm buying a new manufactured home. I go to a dealership, and this is where it's actually a lot more like an automobile. I purchase my home, similar to buying a car still. And at this stage, it's personal property. Now, I can put it on owned land, just like I did for a site-built home. And over 60% of families who are in manufactured housing do put it on their own land. But then it can either be kept as personal property or I could retitle it as real estate. And this decision is extremely important because only real estate is eligible for a mortgage and they come with stronger consumer protections and generally lower interest rates. Or I could put that home, that same home, on family land or on rented land. And it could be in a community in many different ways. So if it's in a community or on family land and I'm renting it or I'm, not paying my family member, then the only way that it could be financed, a couple of ways that it could be financed would be a personal property loan or potentially some kind of seller financing or cash sale. And I wanted to give a little sense of what it really means to have a personal property loan compared to a mortgage. So the Consumer Financial Protection Bureau recently released a new report on manufactured housing finance, and they looked at 2019. And based on that, they found that in manufactured housing, personal property loan at the median had an interest rate of about 8.6%. compared with a manufactured housing mortgage of 4.9%. So quite a huge difference here. And it's notable here for me, I was surprised to see that people who have personal property loans have a very similar credit profiles as those who get mortgages. So the difference in interest rates really doesn't have to do with a risk factor about the borrower. So let's say I'm going to buy my manufactured home, and I'm going to buy this home and I'm going to place it on my own land, but I'm going to keep it as personal property and I'm going to get a personal property loan. My neighbor is buying the same home, putting it right next door and getting a mortgage. So I'm going to pay 8.6% and they're going to pay 4.9%. What's the difference here? Well, monthly it's about $154. But over the course of my 20 years paying $70,000 loan, that's a $37,000 difference. And more than that, well, not more than that, $37,000 is quite a lot. But in addition to that, on a personal property loan, the consumer protections are a lot less, especially if I miss a payment. In those cases, these homes can be repossessed in many states, as compared to my neighbor who got a mortgage. And if they fell behind, they would go through a much lengthier foreclosure process, which is much more protective in staying in their home. I wanted also to just show you, this is also from the Consumer Financial Protection Bureau's most recent report. So I wanted to look at this map with you. And just to give you a sense of it, these circles indicate, the size of the circles indicate about how many loans were made in 2019 relative to each other. The blue pieces of the pie chart are manufactured housing mortgages, and the orange are chattel or personal property loans. And as you can see, there's a lot of variability depending on the state. But it's not totally clear yet why there's such variability. It could have to do with titling laws, land ownership, owner preferences, or something else. But what we do know is that nationwide, Black, African American, and Indigenous populations are more likely to use personal property loans. And the CFPB found that this is true even when those populations own the land. And as I mentioned before, financial profiles are very similar between personal property loan borrowers and manufactured housing mortgage borrowers. So this is an area that we intend to research more and try to understand what's leading to these differences. So we've seen some recent changes and proposals, both at the federal level and at the state level. So at the federal level, we currently have duty to serve for Fannie Mae and Freddie Mac, and those are encouraging increased financing for manufactured homes. And then some proposals at the federal level, like the Manufactured Housing Tenant Protection Act. And cities and states are starting to take some steps like preserving manufactured housing communities as a source of affordable housing, title reform, land lease protections, and changing zoning to allow more manufactured housing. So we've covered an awful lot today, and I wanted to take a step back, not just on manufactured housing, but on all of the details that Tara went through. So overall, low-cost homes are available, but it's difficult for people to obtain financing. And millions of families continue renting or using non-mortgage alternative arrangements and financing to purchase their homes. In manufactured housing, it's the most common type of unsubsidized affordable housing. However, zoning and titling, financing challenges all undermine the effectiveness of it. And as federal and state legislators continue to think about housing affordability, it's really important to be mindful of access to financing as well as the consumer protections. We have a number of upcoming research projects that will come to fruition in the next year. We're working on a national survey on the incidence of alternative financing. We're also looking at alternative financing laws and the consumer protections by state. And in manufactured housing, we're looking into the access to financing and how those play out for different populations. Thank you all so much. Please connect with us at pewtrust.org/home financing. We have a newsletter and would love to stay in touch. Feel free to email myself or Tara Roche. And with that, we'll go to questions and I'll figure out how to stop sharing. Let's see. There we go.
Great. Thanks so much. And we did see quite a few questions in the chat, which is great. So I was wondering, could Michelle Arnold, could you unmute yourself and ask one of your questions? I know you had a few throughout the presentation, so I'd love to hear what's still top of mind.
Hello, everybody. It's great to see everyone. I am a local real estate agent in New Jersey. I've been practicing 25 years. I sit on local, state, and national committees. So I was very, very interested in this presentation, and thank you for all of the information. Some of the things that I noted is that the ownership aspect of it sounds very much to me like a life estate where somebody owns the property and yet somebody else has possession of the property. So there's a correlation there. Also, there are municipalities here where, as a realtor, I was not permitted to sell a manufactured home because it is considered to be personal property. And you're absolutely right. They could not get a mortgage for the property. The seller was kind of stuck with it. It had to be sold as a motor vehicle because it came in on a chassis, and then you would get a title. And I was not aware that there are personal loans out there for the purchase of that type of an entity for a 20-year term. That was one of the other things that made it very difficult to sell that piece of equipment, I guess, or that home, because the personal loans did not go out as far as 20 years. They were maybe 7 years, very similar to a car loan, which made it, of course, cost prohibitive for people to purchase that as a home. So I do have a lot of information, a lot of context, and I'd be happy to help.
Thank you. That's really great. I mean, on the time frame, that's really interesting, and we've heard a range of things from different experts. Nationally, the median for a personal property loan is 20 years, but I think that there's some variability there based on the age of the home and probably also the state. So that's interesting to note. And when I've talked to some other experts, they've mentioned that when you have a 7-year time frame, especially something so short, the monthly payments are quite high.
Thanks for your question, Michelle. I just want to touch on the comment you had at the top about the life estate. So I think that's right. There are definitely some similarities here. My understanding with life estates is that in that joint property ownership, the person who owns it shares it with someone that can take possession upon the original owner's death. And so this is often common in family situations where parents want to hand down the home to their child. I think the difference here too is that this is a very clear kind of arrangement. And so there are these, it's probably a formal contract too that lawyers could draft, but there's very clear ownership rights and responsibilities. Whereas in alternative financing arrangements, it's pretty murky sometimes. We've seen contracts that are literally written on the back of a napkin, that people hand draft on paper. We've seen ones that look much more formal, ones that say you're not allowed to record this, even though the state may say that's actually illegal. And so there's not a standard for those in the way there might be for a life estate arrangement. And those details really have a big impact on ownership and the ability to sell the property or to tap any equity. But yeah, at a high level, they certainly sound similar.
And you mentioned equity. When that purchaser then turns around to sell that property, do they get the benefit of the interest or the equity that has been accumulated?
Yeah, so this all hinges on who has the deed or title in hand. And so, say, for example, you sold me the home. Through alternative financing, we have a land contract arrangement together. The agreement is that I pay you for 20 years until that's satisfied. So you're holding on to that deed for 20 years. In the worst case scenarios, we've seen instances where you as the owner have turned around and sold it, or you still have another mortgage on it. And now this becomes like a wraparound mortgage situation. And so that's very risky for me because I don't have any interest. If I lose that home because you've missed a payment, that's it. Any equity I've put in, any payments, gone. In a situation where that would work out, I would get that title or deed upon my last payment at year 20, and then I own the home. And so I could sell it in theory. I have all those rights and responsibilities that typically come along with home ownership. But from what we've seen in existing research and are starting to uncover ourselves, not a lot of people make it to that final payment. It can be a very difficult process without a more structured contract like a mortgage in place.
It's also risky.
Oh, we do have a couple more questions. So I did want to get just to Councilwoman Creasy as well before we run out of time. And if you don't mind unmuting, Councilwoman. Perfect.
Hello, everybody. How are you? It's a pleasure to be on this forum. I just wanted to make certain that everyone knows. I had a situation where I bought my property here on Madison Drive, and at the same time, there was a buyer approximately 3 doors down from me. Same house, same block, same area, but our APRs were different, and the price of my home was higher than hers. And this happens a lot. There is a lot of discrimination going on when I'm trying to invest and buy property. And of course, I do want to be one of those parents who's able to hand the house down to my children. But it's going to be a feat for me to get to that last payment due to the arrangement that I took when I purchased my home without having education on in particular things I could have done to protect myself. So I am very pleased to be in this meeting. The information that I am receiving is very welcome to my ears. And I would just hope that everyone also considers the situations that happen with minorities and different ethnic groups with purchasing property. Thank you so much, and it's a pleasure to meet you all.
Thank you so much, Councilwoman, for providing us with that context. As you discussed, and as we had a bit throughout our presentation, there are absolutely disparities across race and ethnicity in mortgages, as we well know, and certainly in the alternative financing sector. And it's a little harder to see those disparities because they're not recorded like mortgages are all the time. But we're spending some time to dig in further about challenges that specifically affect groups that have been typically underinvested or have been subject to higher fees and rates, and really look forward to providing some more research to help fill in those gaps and highlighting some of those really unfortunate challenges and some of the systemic problems that exist in this space. So thank you so much for that. It's a great point to underscore.
Thank you so much. And I will keep up with you. When you find out more information, let me know. I'll help you with it.
That's terrific. Thank you.
Great. And I don't see any other questions in the chat. Does anyone have anything else to ask our speakers before we close out? Feel free to use the hand function or chime in on the chat if you have anything as we're wrapping up here. And otherwise, Jody, I'll turn it over to you to close.
Okay. No other questions? All right. Well, thank you very, very much.
Oh, wait, I do see the hand function.
Okay.
Sorry,
Go.
since we're a little ahead of schedule. I see Judy Gatlin. If you want to unmute and ask your question.
Yes, thank you. Welcome. It's good to see everybody. I'm from Eau Claire, Wisconsin, and I'm on the county board. And I live in a manufactured home. After a divorce, I had to buy a new home, and I did not have the revenue or the wages to get a mortgage. And soon afterwards, I realized that how predatory it is when you buy a mobile home and you put it in a mobile home court, also called a trailer, also referred to as the trailer court. Very high interest rate, higher. I started higher than that median you just put out there. And this was in 2001. And mobile homes, you put them on the lot and they depreciate the next day. And then you're in a trap with the people who own the court. And a lot of these communities and gated communities and mobile home courts are being bought up by investment groups that can easily raise the rent. Now, my neighbors are people on fixed incomes, minorities, people who are disabled, elderly, because it's the only thing that's affordable. So they really get in an awful position because you can't just pick up your home and move it. And as somebody mentioned, I think it was New Jersey, Wisconsin and Minnesota, very limited where you could put a mobile home. And most of the time it's just, you buy some land, you could put one on there while you build a house. So I would like to see cities and states and counties do more to help low income people purchase a mobile home and have it in a place that's affordable. Even CAP agencies, what they offer, they don't offer those services to mobile homes. You can't get subsidized rent, like you said. Public entities do not seem to want to get involved. And I think mobile homes are affordable. And I think that if you're in a community like Eau Claire, Wisconsin, that homelessness is continuing, growing, I would like to see more of my policymakers find a way to put these people into manufactured homes. Thank you.
Thank you so much. I appreciate that. This was very, very good. I mean, this is a lot of information. And speaking of this information, all of these materials will be housed on our website. We're going to email it to you, but then we're also going to house it on our, post it all on our website. So don't worry about not having access to it or anything. Well, again, Tara and Rachel, this was very informative. We appreciate it very much. The people at Pew we call them the gold standard. When they do research, it's not biased, it's not weighted, it is pure research, and we very much appreciate you ladies presenting to us. And with that, we're done. And thank you all for joining.
Thank you for having us.
Thanks so much. This has been such a pleasure.
Have a great day.
Aloha, everybody.
And
Bye, thanks so
awesome.
much.
Bye, everybody. Stay in touch.
Bye.
Thanks all so much.
You take care.
Great. All right.
Okay.
Thanks so much, guys.
Thank you.
Bye, Bryn. Thank you.